Yo, what's good? In this video, I'm going to be talking about why rebalancing is important. But before we get started, let me know in the comments, do you currently rebalance your portfolio right now? And while you're down there, please hit the like button as it really helps the channel grow. Let's get started. If you watch any of my other videos, you know that I love to talk about rebalancing and how important it is. A lot. But what exactly is rebalancing? From the Investopedia definition, rebalancing is the process of realigning the weightings of a portfolio of assets. Rebalancing involves periodically buying or selling assets in a portfolio to maintain an original or desired level of asset allocation or risk. This definition sounds way more complicated than it needs to be, so let me try to make it a little bit more clear by going through an example. Let me set the scene. It's 2021 and you're permanently stuck at home because some dude that's related to a truck is acting like a clown. You've started an OnlyFans as a joke, and now you have $10,000 to start investing. Based on a risk assessment that you've done, you decide to invest into a portfolio that's 50-50 stocks and bonds. And let's say this year, the Fed is really at it and they're printing a little bit more money than they should be. Your stocks are doing really well and they're up 20%. On the other hand, your bonds are, acting like bonds move, and they're only up 3% on the year. After some math, you see that your portfolio is now worth $11,650, with stocks making up $6,000 and bonds making up the other $5,650. As you can see, stocks now make up 51.5% of the portfolio and bonds make up the other 48.5%. Now, these percentages are slightly off from our initial 50-50 split. And you might say, hey man, that's not really a big deal. It's only 1.5%, it's whatever. And if you say that, I would agree with you. But if you let this go unchecked year after year, the stock portion of the portfolio is going to compound and it's going to greatly dominate your portfolio to the point where your risk level is nowhere close to being the 50-50 that it initially started at. If this happens, you could potentially be exposing yourself to risk that you're not necessarily ready for or you don't necessarily want. In order to make this portfolio 50-50 again, it's pretty simple. You would just sell $175 worth of your stocks and then buy $175 worth of bonds, just to make sure that the split is 50-50 again. Now, this idea doesn't only apply to stocks versus bonds. You can also rebalance your equities globally. So say, for example, you can rebalance your portfolio so that you're not overweight in one area of the world, say for example, North America. Rebalancing is also really important if you're a stock picker. Investing into individual stocks comes with a lot more risk than investing into straight ETFs. So rebalancing helps you keep your portfolio risk adjusted while making sure one stock doesn't completely dominate your portfolio. On top of that, if you sell some of your winning stocks in order to buy some of your losing stocks, you may come out with higher gains long term because you're essentially buying stocks on sale. Hopefully, my examples have shown you that rebalancing is a great tool that helps you manage your risk. But now you're probably wondering, when do I actually have to rebalance? And the way I see it is there's 3 ways to rebalance your portfolio. The first is to rebalance every time an asset drifts away from its target allocation by a certain percentage or a certain threshold. The second is to rebalance based on time, and the third is to rebalance whenever you contribute to your portfolio. Let's take a look at rebalancing based on percentages first. Say you have a portfolio and you notice that one of your assets is slowly starting to drift away and it's drifted 5% from its target allocation. At this point, you can say, hey, it's drifted 5%, now it's time to do a rebalance to move some of that money in other places. Doing it like this is how all-in-one funds like XGrow and VGrow do their rebalancing. The second way you can rebalance is based on time. Say for example, every year. Doing it this way is super simple because all you have to do is rebalance once every single year and it only takes 30 minutes, and then the rest of the time you're just chilling. And the third and final way to rebalance your portfolio is do it every single time you contribute. This one's also pretty simple too. So basically every single time you contribute to your portfolio, say monthly, weekly, whatever, you just take a look at your asset allocations and the percentages that it makes up in your portfolio. If you notice that one of your assets is lagging behind or is a little bit too low, you can just invest a little bit more money into that asset in order to make everything even out. This also applies to dividends, so you could use the same kind of idea to invest every single 4 months when dividends are distributed, and that way you can even out your portfolio and rebalance every 4 months. Hopefully you can understand the importance of using rebalancing as a tool to manage your risk, but you have to be careful not to overdo it. If you rebalance very often, you could even consider a type of active investing and can actually be counterproductive. This is especially the case if you're using a platform that doesn't give you free commissions on buying and selling. If you're constantly rebalancing, that could possibly mean that you're constantly buying and selling, which could rack up a lot of trading costs and will be really costly on a smaller portfolio. On top of that, if you're investing into a non-registered account, all of those sales that you need to do in order to rebalance are going to trigger capital gains tax. Another note that I want to make about rebalancing is that it's a tool to manage your risk and not a tool to increase your gains. In fact, a lot of studies actually show that rebalancing hurts your gains long term. But wait, Kang, that doesn't make sense. Why are you telling me that if rebalancing is important if it's just going to hurt my gains long term? That's a great point, but my counter argument is gains don't matter if you're in way over your head and you're taking way more risk than you can actually handle, and then you end up paper handing your life savings away the first time the market drops. And by now, some of you may be thinking this rebalancing thing sounds like way too much work, and that's okay, so do I. Luckily for you and I, there are a lot of options out there right now for investors, like Wealthsimple Invest or all-in-one funds that do a lot of the work for you. I have videos on both of those topics if you want to take a look. Personally, I'm far too lazy to manage and rebalance my own portfolio, so that's why I invest into the stock market through asset allocation ETFs. But if I had to manage my own portfolio, I'd probably rebalance once a year. Any more frequent than that, I would become emotionally invested and start trying to optimize my portfolio and doing, I'd be going out of my own lane, basically. But honestly, it's mostly because I'm lazy. Whether you decide to create your own portfolio and manage it yourself, or go with an option like Wealthsimple Invest or an all-in-one fund, hopefully you can understand the importance of rebalancing when it comes to managing your risk. But that's all I wanted to say for this video. Thanks for watching if you made it this far. If you liked it, please consider liking and subscribing. I plan to make a new video every 2 weeks, so hit the bell notification so you don't miss out. If you have any questions or comments, leave them down below or hit me up on Instagram. But other than that, thanks for watching. I'll see you guys next time. Later.